Here's the thing with crypto. A lot of people get in thinking they'll just become millionaires off of some research they did on Wikipedia and Reddit. Sure, there's a lot of success stories out there, but for every success story you'll find tens of scams and frauds. Remember those Squid Game coins that came out last year? Yeah, that happened. That's why in this video, we'll be going through 7 tips on how to get started with crypto. Now, without any further ado, let's dive in. Sitting at number 7, don't buy on speculation. Many newcomers make the error of buying on speculation, which can lead to investors buying high and selling low. Many newcomers simply want to profit from the surge without considering the coin's long-term prospects or the causes that are driving its price higher. Speculation about the large amount of crypto adoption, as well as a broader crypto market rise, led both retail and institutional investors to buy numerous currencies at a higher price earlier this year. The cryptocurrency markets are extremely volatile, making it difficult to forecast future price movements. Investors who bought digital coins during the recent run-up have lost money this week due to a sudden slump in crypto markets, which is being blamed primarily on Tesla's Bitcoin ban. The sell-off was aided by rising Chinese rules and uncertainties. Next up, don't invest when the price is high. One of the main reasons why you probably even heard of Bitcoin or any other cryptocurrency for the first time was because its price was high or skyrocketing. Beginners who don't really know a lot about investing or crypto might think that this is a good time to invest in crypto, but it's not. It can be super tempting to try to invest in crypto when it's high, but in most cases, whenever the value of a crypto is high, most holders will start to sell to reap the profits, and it'll cause a huge crash in the price. For example, back in November of 2021, when Bitcoin reached a record high price of over $67,000, its price crashed down to $46,000 less than a month later. Another month later, the price of Bitcoin was down to $35,000. Go big or go home is not the strategy you should go for here. It's always a better idea to invest when the price is low rather than high. Tip number 5, believing influencer scams. No, crypto scams are everywhere, whether it's maliciously coded cryptos or pump and dump scams. In many cases, malicious crypto developers will try to pump cryptos by using influencers or YouTubers. They tell these influencers to heavily promote that specific crypto on their platform, but in most cases, the vast majority of the tokens will be owned by the developers beforehand. Influencer fans are sort of like zombies. Kylie Jenner fans could literally sell her a jar that she breathed in and it would be sold out in seconds. Once gullible fans invest their own money into the crypto project, the developers will simply sell all of the cryptos they have, causing the price to crash. It's very easy for gullible fans to believe their favorite influencers whenever they promote any kind of cryptocurrency. But in most cases, at least in the cases where the influencer isn't related to crypto at all, it's a scam. You should never invest in a crypto that hasn't been audited by a reliable third party. And you should always be wary of influencers who ask you to invest in the latest Dogecoin Pro Max Special Edition because it'll allegedly earn you a lot of money. Next, going all in on one crypto. You might feel like you found just the perfect cryptocurrency to invest all of your savings in, but that's a horrible idea. Whether it's cryptos, stocks, or any other kind of investment, you should never put all of your eggs in one basket. You should try to diversify your crypto portfolio as much as you can, and this also includes diversifying your overall portfolio. Even if you invest in a bunch of different cryptos, you can't just have it be the sole industry you invest in. That's because even the crypto market is linked to one another, and a decline in one crypto might also mean a decline in another crypto. If you are going to invest, do so in as many fields as possible so that you can take the least amount of risk possible. And number 3, low price doesn't mean it's cheap. Thousands of meme-inspired coins have been circulating in retail markets, the most majority of which are unacceptably low in value. Investors are buying them with the hope of turning them into a $1 million bet one day. They do this by pursuing meme-inspired currencies that may be purchased in large quantities. The Dogecoin, which began trading at a modest price and suddenly skyrocketed in value, making early adopters millionaires and billionaires. To be clear, a low price does not imply that the coin is for sale. It does in fact reflect its genuine value and demand. In the instance of Dogecoin, Elon Musk's support was important in increasing demand and encouraging retail investors to invest in meme coins. There are hundreds of other currencies trading at a very low price, but due to poor demand and volume, these coins frequently evaporate, resulting in losses for investors who try to be early adopters. Because investing is all about producing money, you should concentrate on the profit potential when making decisions. You must comprehend numbers in order to determine whether or not an investment is profitable. You never know if you're generating a profit if you don't pay attention to the figures. Cryptocurrencies are extremely volatile, with price fluctuations occurring every hour or even every day. You need to think about transaction costs if you want to take advantage of these pricing adjustments. Transaction costs can eat up a significant percentage of your profits, so keep an eye on them. Taxes are another factor to consider when investing in cryptocurrencies. If you don't factor in taxes and fees, your crypto winnings could turn into losses, especially if you trade frequently. Next, don't forget your risk tolerance. Don't put money into something you don't expect to lose. It's all about winning and losing when it comes to investing. However, losses can be reduced by strategically allocating investments based on one's risk tolerance. Purchasing cryptocurrencies while withdrawing funds from other investments could be a risky move on several levels. Instead, it appears that sticking to your long-term investments while allocating a small amount of your portfolio to risky assets is a safe general strategy. Investors would struggle to reach their financial goals if long-term investments were broken. You'll hear acronyms like FOMO, HODL, and FUD when it comes to crypto investing. These abbreviations stand for a crypto approach that is based on emotion. You must not allow your emotions to influence your investment decisions. FOMO stands for fear of missing out. Don't make the mistake of investing in a crypto coin just because it's hot or popular. Fear, uncertainty, and doubt, or FUD, is a phrase that simply means fear, uncertainty, and doubt. FUD keeps people from investing even though market emotions or research data indicate that now is a favorable moment to do so. The abbreviation HODL, or HODL, stands for hang on to your investment. What it means is that you should keep your money in the market even if there is a lot of volatility. While it is acceptable to hang on to your investment at times, you will not always have the time to wait for a significant return on your investment. You may have to cut your losses at such times. And sitting at number 1, make your exit strategy before buying. Purchasing any asset, especially a digital coin, without a plan of exit could be disastrous. To achieve your core aims, you must have your stop losses in place and a conceptual framework laid out ahead of time. If the market climate continues to deteriorate, it is impossible to allow losses to accumulate. Exit strategies aid investors in avoiding large losses. When it comes to investing in and trading cryptocurrencies, the worst thing a crypto enthusiast can do is not plan ahead. A decade ago, an average home computer could mine an amount of Bitcoin that would be worth a fortune today. However, currently, the phrases cryptocurrency and competitiveness are nearly synonymous, implying that prospering in the crypto market is not a beginner's chore. Before making any decisions, you must be strategic and have clear goals. When you don't know where you want to go, the risks of financial loss are significantly higher. As a result, you must first identify your objectives and aspirations before entering the crypto market and benefiting from digital assets. On the other side, even if you win the bet, you should always have an escape strategy in place. Investors who do not have a thorough understanding of market psychology may lose money if they do not sell on the increase, owing to anticipation of continued price growth. Knowing when to sell and when not to sell is the greatest way to maximize profits or minimize losses. JP Morgan published a thorough research with analyst Nicholas Panagiotsouroglu at the start of this year. JP Morgan Chase analysts predicted a long-term Bitcoin price goal of more than $146,000 in a research note to clients, based on the expectation that the cryptocurrency will gain in popularity as a gold substitute. That's a wrap for this video. What are your favorite tips for starting out in crypto? Let us know in the comment box below. And if you liked this video, don't forget to give us a thumbs up and subscribe to our channel. We'll see you next time.